Well, hello all, and welcome to today's webinar. It's just gone 12 o'clock on Wednesday, the 27th of September. Great to have so many of you on the line today, and Shawn and Harry Watt I'll bring in very shortly. So today's webinar is looking at the opportunities in the unloved sectors of the market. It's brought to you by Market Matters. We're doing more regular webinars, so thank you for the many attendees who have jumped on the line today. We're going to try and be short, sharp, succinct, and provide you with some ideas, opportunities in parts of the market that have been sold down, unloved in the last few months. So we're all about offering real market insight, opinions followed up by action. So we'll try and deliver some of those to you today. I'll bring in Shawn and Harry. You can kick off your videos there, and we'll bring the guys in. Shawn's, of course, our research lead at Market Matters. A bunch of decades of experience in the markets, very focused on the macroeconomic side of the markets, timing of markets, etc. So welcome, Shawn.
Nice to be here, James.
And Harry, portfolio manager at Market Matters, part of the investment team, sporting an interesting mo, and it's not even November. Harry.
On early on November, James. I'll have to get some fundraising going, but good to be
here. Coming off the back, have you seen how much money we raised on the Apex Outback Postie bike ride, and he wants a slice of it. So I'm just going to run through a quick disclaimer to get things kicked off here. There's just a quick bio of the team that is on your screen now. Lots of years of experience. We're active in the markets on a daily basis. We're managing a fair amount of money now in the markets these days, and we're writing about our experiences, what we're seeing in the markets, and publishing that to Market Matters members. So welcome to all our members on the line. If you're not a member, you should be, and we're going to run you through some of the ways you can engage with Market Matters throughout this webinar. Before I begin, just a reminder that all advice provided in this presentation is of a general nature only. There's more in depth in that disclaimer, so I encourage you to read that, but stress that it's general information only. Just before on the screen there's a bit of performance statistics around some of our portfolios. Today's webinar is going to focus on three key areas. So it's going to look at healthcare. There's a lot going on in that space. We're going to drill down and give you some insight into our views around ResMed, which is a very topical stock at the moment. We'll probably spend a little bit more time on ResMed than the others. We're then going to move into, we've got some small cap ideas for you. The small caps have been big underperformers in the last 12 months. So we're going to focus on that area of the market. And then we're going to finish off on the consumer staples space. A little bit boring, but we think there's probably some opportunities in that area of the market, given the underperformance in the last couple of months, or at least post-reporting. Good year for Market Matters portfolios in FY23. The stats are on your screen there. Flagship growth portfolio was up 24%. The market was up about 14% over the course of that year. International equities did well. The active income portfolio performed aligned with its RBA Cash Plus 4 benchmark, or did better than that. And then the emerging companies portfolio lagged, but it was still strong. Just to give you an idea of how we're performing so far in FY24, the flagship growth portfolio outperforming its benchmark. It's up 1.13%. This is as of a couple of days ago. The market's actually down in that time period. And the more defensive qualities of the income portfolio, which is up 2.05% ahead of its benchmark, but about 2.5% above the market. I haven't got them on the screen there, but to give you an update on the emerging companies portfolio, it's actually up 5.59% FY24 to date versus Small Ords down 1.64%. And the international equities portfolio is up about 1% financial year to date. Moving on straight into what we're seeing in terms of the ASX just generally. Pretty much a year of sideways trading action. The market is flat for the year. Just from an index point of view, Shawn, I'll bring you in just quickly here, just touching on how you're seeing the index at the moment.
Okay, thanks, James. I think there's 3 points we should be looking at here. The first, you've heard me all write about it a lot over the last 6-12 months. We don't believe people should be focusing on the index. It's going sideways. It's been going sideways for a few years now. Focus on the stocks, focus on the sectors. Until further notice, this index is going nowhere. That will change, of course. It always does. But at the moment, leave it alone. I wouldn't even be looking at it more than a cursory look occasionally. Excuse me. The second factor is that we are seasonally, because people are going to still say, but what do you think, Shawn? I hear it all the time. Seasonally, September is the weakest month of the year. It's been a pretty bad month so far. The next quarter is the strongest. It does have a habit of running into December. The real strength normally comes through in December. We think the market's coming into what we call a buy zone. And for people that do like to swing their portfolios up and down around the actual seasonals in the market, this is the time when we think one should be getting more overweight stocks. And thirdly, and most importantly, I guess, something else we've been writing about a lot over the last 6 to 12 months, this market is being dictated to by bond yields. Bond yields are at more than decade highs over the last 48 hours. Higher bond yields weighs on stocks, weighs on growth stocks, and we're seeing that at the moment.
Yeah, bond yields. We write a heap about bond yields, Harry. We just had inflation data out about half an hour ago in Australia, in line with expectations. Our view is that bond yields are near a peak. We haven't seen it yet, but bond yields, in our view, are near a peak. There's already another 20 basis points worth of tightening priced into Aussie bonds, so interest rate futures. So we think we're there on interest rates.
Exactly. And if that's the case, the market's gone from being complacently thinking we had a peak in interest rates to now getting scared that we're going to get more hikes. Obviously, the Fed really reinforced that over the last few weeks. We think they're getting ahead of themselves. Our view is the Fed was just really talking some common sense. They're just saying to everyone, okay, things looking okay here, but if inflation goes again, especially with petrol prices so high, we're not scared to hike again if need be, but we don't believe they will.
Yeah, and we're seeing that in the longer part of the US yield curve. So 10 years are moving higher, 10-year yields are moving higher and closing some of that gap between the 2s and 10s, which basically just is pricing in that softer economic landing that we're all seeing in the economic data.
Exactly. So basically interest rates higher for longer, but not really any higher. I mean, interest rates, in my opinion, they could go sideways for 6 or 9 months. They could become more boring than the ASX has.
Yeah, and we have been writing about a lot, but and I know it can get a little bit monotonous, but they really are important. Now I'm going to move on to what we're seeing in terms of the healthcare sector, because this has been a real. You think about healthcare stocks as these defensive, high-quality plays, consistent earning streams that in times of instability, uncertainty, etc., people gravitate towards the healthcare space. The healthcare index or sector is down 8.5%. The course of 2023. It's the worst performing sector. From a sector point of view, Shawn, we look to be near lows.
I think so. I think the elastic band is starting to stretch between, shall we say, the tech sector and the healthcare sector. I don't think it's necessarily there yet, but I think the time to buy healthcare is approaching fast, a bit like it was approaching fast this time last year with the tech sector. In the back end of last year, nobody wanted tech. It looked awful. Subsequently, this year, it's up almost 30%, and a lot of the stocks are up a lot more. So I think the market has a habit of going all in the wrong way too often. I think that if we're correct with the bond yields, then the healthcare sector should pick up. And we've also had a few really bad performing stocks locally, right from CSL's down over 10%, but then the likes of ResMed, Ramsay Healthcare, Ansell, Helios, they're all down over 20% year to date. So there haven't been many stocks coming through and fighting the trend.
So just to give you an idea of the tech index, it's up, as Shawn mentioned, nearly 30%. Reads consumer discretionary stocks, so the retailers are actually up 13% year to date. They were that sector that the market was so concerned about. Then you think about staples, which are down, healthcare, which is down. They were the defensive areas of the market that a lot of people, a lot of investors were gravitating to 6 months ago. Now let's just get the elephant out of the room. So we've got ResMed on the chart there. It's down 40%, as you can see, from recent highs. We own ResMed. We're going to focus on what it's done to our portfolio performance during the last month has been in particular where the weakness has played out. To give you a backdrop in where ResMed sits in the broader sector, so we've got ResMed down 30%, we've got Ramsay Healthcare down 20%, and CSL is down 11%. I'm just going to focus a little bit on the thesis around why it's down, just to bear with me, and I'll give you a quick background around our views on ResMed and why we've held our position so far. We haven't added to it in the last couple of weeks, but while we've held it, there's a huge, a lot of talk about obesity and drugs that will tackle obesity. I think the first important point I'd make is that obesity is a huge problem. So it's rising as global wealth. So as populations get wealthier, they get fatter, they get more obese, and obesity becomes a bigger trend. It's not something that is sustainable. So healthcare systems cannot handle the rise in obesity. There's a huge number of flow-on impacts that obesity will have. Obesity correlates with obstructive sleep apnea, OSA. So the greater rates of obesity, the greater rates of sleep apnea, and the more products that ResMed sell. So this is ResMed sales on the chart in black versus the estimated US obesity rate. So you can clearly see the trend there. So that's a clear link between obesity and OSA. On the 3rd of August, that's in US time, so that ResMed came out with their fourth quarter earnings numbers and full year earnings numbers. This is before any of the concern came to fruition around these weight loss medications. They showed a decline in margins when the market, or they had previously implied that margins would increase. So that was the biggest sort of red flag from a market's point of view. The stock fell 9% on that day. 4 days later, so on the 8th of August, Novo Nordisk had this clinical trial, a very substantial clinical trial, nearly 20,000 participants, called the SELECT trial. They came out with their results, which effectively showed that they had a huge amount of significance in their study that showed that their drugs caused pretty significant weight loss, and if rolled out more broadly, that could be a big beneficiary to this huge trend around obesity. So that's how it played out. The market has then extrapolated that into bidding up those companies that produce those sorts of drugs. So Novo Nordisk is one of the main ones, but there's also others. So Eli Lilly, that we spoke about or wrote about in our morning report this morning, has also been a big beneficiary of these, and they sold down ResMed. So, and they sold down other sleep apnea providers, as well as diabetes, as well as insulin companies, as well as a bunch of other things. So there's the companies that benefit from this key development, and there's those that obviously have got an issue in terms of their earnings profile as a consequence of this. What I would say, and this is an earnings estimates graph of ResMed. So the red line there is the consensus analyst earnings estimates going into FY24. The white line is the ResMed share price. There hasn't been a change in analyst expectations around earnings. Why? Because it's unknown. There's no, we haven't seen the data. We haven't seen a lot of the impacts in real time. ResMed themselves have come out and said they haven't seen any impact at this stage, and that's why analysts haven't downgraded their earnings estimations, because they haven't got any basis to downgrade those on. So all of this, shown very clearly on that chart, is around fear of the unknown. Our view is that ResMed is now priced in a pretty dire outcome, a lot of certainties that are simply uncertain. So that's why we stayed the course with ResMed. If you look at the earnings multiple that ResMed now trades on, it's about 19 times versus historical averages of 34 times. It's never been as cheap, or very rarely has it been as cheap in terms of ResMed. So there's a lot of negativity priced into the ResMed share price. There's a huge amount of unknowns, and just on the screen there, I highlight 8 of the things that we should be cautious on when we're thinking about Ozempic and other weight loss drugs. They're not as simple as the market or the media is portraying them to be, and there are some side effects. Now, I'll rewind the tape and just reiterate the point that obviously obesity is a huge issue. There's a huge amount of incentives globally to tackle obesity, and therefore these weight loss drugs and anything that does do that to tackle obesity and works in terms of tackling obesity is going to be embraced by governments, and obviously they're going to be positive for those companies that produce it, and less positive for the companies like ResMed who have the products that are benefit, I guess, from that rise in obesity. But it's not a layup. It's not a fait accompli at this point. This is just a quick quote from the CEO of ResMed at their Q4 earnings call, and he talks about the cost of some of these weight loss drugs and how prohibitive that is over time. So I'll leave you there to read that. And there will be a recording going out of this presentation, and we'll attach the slide decks on the back of this. But I think from a specific ResMed instance, the market has run with its feet. They don't like the uncertainty that this has created, and the stock has been sold down as a consequence of that, Shawn.
I mean, I wrote down this morning when I was making some notes for today's webinar that I felt that at least the next 10 or 15% was up in ResMed. It's up almost 6% today, so it's a bit past tense already. I believe the stock has literally, and sort of paraphrasing what James has said, I believe the stock has run too hard. It's building in all of the bad news. I'm not a firm believer in that there's a silver bullet. If there was a silver bullet, everyone would have jumped on Jenny Craig and lost a lot of weight that way. I still believe the demand for ResMed products is going to be strong going forward. And we've still got other parts of the world that are going to take on board more sugar, whether it be parts of India, parts of Africa, South America. It's also going to increase demand for the products. So there's a few moving parts here. It's not just a case of Ozempic will make everyone in America lose weight. It's not going to happen like that. So I think that the market is factoring in almost worse than the worst case scenario. And by definition, we haven't sold our position. Do we think it's good news? Of course, it's not good news. It's not good news at all. But there's a point in time where we'd rather be a buyer than a seller, and that's now. But prudence says we don't want to increase our position. And that's kind of how I see it just here.
Yeah, you'll have some short and sharp bursts in ResMed. So the short position over in the US has increased markedly in this stock over the past month or so. So I've only got data up to the end of August, but there was about $550 million short in ResMed, which is ticked up markedly. I'd suggest that number has gone a lot higher in the last 3 weeks or so. So there's a big short position. So we're going to see fits and starts. We actually think that the ResMed multiple will be lower going forward than it has been in the past. So, you say through 5 years it's been trading on 34 times and it's now trading on 19 times. We don't think it will gravitate back to 34 times because the changing landscape. We're simply saying that right now it's oversold, and 18 or 19 times is not the right number. Somewhere in the mid-20s is the right number. But if that plays out, then ResMed should rally 10, 20, 30% from these depressed levels in our view. Just in terms of portfolio impact on ResMed. So we've got a 4% weighting in Invest in ResMed. Last month in August, it took 1.2% off our portfolio performance. So portfolio was down 1.54% in the month. The market was down about half that. But ResMed was 1.2% and Ramsay was another 58 basis points. So when you combine those two things, 1.78% of negative performance came from two stocks. So the rest of the portfolio did particularly well in that environment. So just want to highlight one of the things that Market Matters we're really strong on is around transparency on the, when things go right, transparency when things go wrong, and the actual impact, the economic impact that our decisions have from a portfolio perspective. And you can clearly see on the screen there, not a good month, but if I look at every other time frame, that portfolio is performing really strongly. And I'd hate to for people to focus too much on the 1 month, given that we've been caught with obviously ResMed in that portfolio. I'm going to move on to CSL, another one in this space that obviously has been sold down. So it's not just ResMed that has been sold down in the healthcare space. CSL's down 11% year to date. It's now trading on 26 times, generally trades on about 35 times. So there's been a big re-rate here. The market still loves CSL. The 16 buys, 2 holds, no sells. So the market still loves it. Consensus price target is 325. which implies about 30% upside in my if my maths is correct. I'm not as Sean's. We've had discussions about CSL, I should say. Sean's more bullish than me. I think there's a risk around that. The $18 billion acquisition they made in 22. The difference between CSL and it's on this chart here is that earnings have been cut in terms of CSL, Sean.
No, absolutely, James. And one of the reasons why we haven't purchased the stock is because of that very pullback in earnings, and because you and I aren't on the same horse occasionally. But I think that if we go back to the previous slide, James, if that's possible, it's very, very important to bear in mind just what we're seeing here. The market is long; it loves CSL. So one of the reasons we haven't pulled, even though it's on a valuation a lot lower than it has been in the past, and it should be, I can see a washout in this stock. And by that, I mean, everyone's long. You've only got to look on the Market Matters website. Everyone loves the stock, et cetera, et cetera. If it starts going underneath $240, for example, you're going to see a lot of people throw in the towel, and that's where the valuation can come in. So, it's sort of around that hit list on the flagship growth portfolio. There's a big difference between being on the hit list and actually pulling the button and saying, we're going to buy it right here, right now. I can see some washout in the stock. It's the healthcare sector as well. We've also got to bear in mind when we were looking at the pullback in the portfolio, James, on both Ramsay and ResMed. Of course, the healthcare sector has had a shocking time. And I still believe that the playing out across the sectors has got further to go, in which case we could quite easily see CSL drop another $10. It's not a great deal on a $250 stock. So I do prefer it to you, but I think there's a strong possibility of a washout, which would then give some very good deep value, especially if the market got even more defensive.
Yeah, it's an interesting one. You can clearly see on the chart there's a lot of support there, whether it's 240 or 250. I mean, we're talking $10 in a $250 stock. It's sometimes sometimes we can try and get too cute around purchasing. I would stress that I think CSL is more a buy than it has in the past. We've owned CSL, we sold it at higher levels, we trimmed our position above 300, we trimmed it, we sold out of it on the way down. We've made money out of it. We're now looking at levels to accumulate the stock rather than sell the stock here. So we'll move on to CSL. I just, that earnings, you can clearly see that there's been a huge reduction post their FY24 results. Ramsay is one that we've...
Sorry, James, just to interject there. For us to buy CSL means that we've got to go overweight healthcare from market weight. The market weight has already weighed on our portfolio performance. So that's either we switch out of either Ramsay or ResMed, or we have to go overweight healthcare. And that's a big step at this moment in the cycle.
Yeah, it's we're not adverse to doing that. I'll stress. I mean, I think about times to be going overweight sectors, times to be going underweight sectors. Clearly, healthcare is unloved. It's down 8.5% this year alone. There's not many times historically that it's been down that much. The US healthcare sector is not done as badly as our own. Healthcare stocks have pulled back there, but they haven't pulled back as far as our own. So, there's I guess what I'm saying is there's signs to be stuck, being more optimistic on healthcare. And we like going overweight sectors when they're unloved. We like going underweight sectors when the market is positioned all in one way, when the market is universally bullish a particular area of the market. That to me is the example of that at the moment. Ramsay is a little bit different. So Ramsay is down 20% year to date. They've had their earnings have not recovered as quickly as the market had anticipated them to be. They're a far cry from the KKR bid at $88 a share back in 2022. They've got a bunch of property assets that underpin the valuation of Ramsay. We've stayed patient because of the embedded value on the balance sheet, but we need to see that earnings recovery start to play out, Sean.
Oh, exactly. It has been a frustrating ride. I mean, a couple of times I had to take a deep breath when I thought about the directors not jumping up and down to try and make the KKR bid go ahead, because that's what most shareholders, including us at the time, would love to have happened. But now we've got a situation where the stock's down near $50. They have got a lot of assets on the balance sheet. I'd be much closer to being a buyer than a seller down here. It's been a lot lower than $50. That 54.10 actually needs upgrading, or updating, I should say. Patience is probably warranted here as well. I mean, I don't feel like this is the right time to be selling the stock, but it has been a frustrating ride.
All right. If we didn't own it, I would be ponying up to buy Ramsay Healthcare here. I think we've seen, so just on this chart here, you can clearly see that capitulation of analysts post their FY24 results. So there was big earnings downgrades as a consequence of their FY24 results. I think from an analyst point of view, a lot of analysts capitulated at that point and they pushed through really meaningful earnings downgrades. That's pushed up the valuation of Ramsay out to FY24. It's not cheap. So if you screen for for a PE multiple on Ramsay, it's still elevated because those earnings have been cut so markedly. So, best estimates $1.43 for their EPS in FY24, which makes it fairly expensive. But I think it's that capitulation that's already played out. Now, Harry, I haven't forgotten you're there, mate. Now is your time to shine in terms of some of the small caps. So Harry heads up the emerging company strategy at Market Matters, as well as contributing to the reports, etc. Small caps have had a very difficult 12 months. Small cap index is down 3.3%, just to put that into context. So, and I'll use a US example here. So the Russell 2000 in the US is flat year to date. The S&P 500 is up 11% and the NASDAQ is up 32%. So we've experienced those similar trends here. Is now the time to be looking at small caps, Harrison?
I think it's time to start definitely allocating to small caps and starting to build a position there. You can see it's probably not so much the last year, it's the last 3 years. So coming out of 2021, you can see that the small cap index and the large cap index basically topped out at a pretty similar level there in a relationship chart there. And but the small caps come back really substantially, whereas the large cap index has sort of held its own. Small caps do outperform large caps on a sort of longer term time frame. They tend to do pretty well. It's obviously a riskier end of the spectrum for investment, but and that volatility does play into it. But this is quite a substantial underperformance period we've seen from small caps, both locally and in the US. So, definitely having some in the portfolio and continue to allocate towards that smaller end of the curve makes a lot of sense.
Well, let's give some ideas around what we should be allocating to. So a couple of stocks that we want to focus on now, they've been beaten down. We see value in them. We haven't got, at the back end of this presentation, we're going to focus on some high conviction stock picks that we've got. These aren't those, but they're stocks that we like at these current levels. So Catapult, CAT is the ticker on your screen there. Technology company involved in sports analytics. It's got a $254 million market cap. We own this stock. We bought it at $1.09. It's now 98.5 cents. We've got a 3% portfolio weighting in this stock at the moment, so it's small. We like it. Why do we like it, Harry?
They came out with a quarterly update not long ago. Their average contract value is growing pretty substantially at the moment. And that's sort of a tailwind for Catapult as they move to free cash flow positive. So they're spowing insanely well.
You're just breaking up. You're just breaking up there, Harry. So we'll try and refresh your line a little bit, give you a chance to.
I'll make a quick comment there, James, while Harry has a play with his mic.
You look at NRL plus at the top there, jerseys flies into the market and is doing really well out of. They've also tagged on a video streaming system that's been an issue for them recently, but that's starting to work through as well. So it's a business that's sort of in a space that's growing massively, and it's sort of at the right end of the curve and at the right time to invest as you move to free cash flow positive in our view, James.
I'll just, I know Harry broke up there halfway through that, so I'll just recap some of the main areas there. So, you watch the NRL Grand Final this weekend, and you'll see little packets, little squares on the back of Payne Haas's jersey, and the other guys playing in the grand final this weekend, and that's a catapult product. They've moved more towards the software side of it. There, as Harry made mention of just then, they're bringing in video, and they do a bunch of analytics around how sports people are performing and how they can get better performance out of them. That's in a nutshell. From a business point of view, they've had a few false starts over the years, so they've invested heavily in products rather than software itself. That's been costly, and they've had a few corporate issues that have played out. But the distilling it all down, they've invested a truckload of money. The share price right now is not reflecting the investment they've made, and moving forward, they're going to realise some of those benefits of the history that they've had over a number of years now, Harry.
For sure, James. Yeah, free cash flow positive FY24 is what we're expecting. And in small cap space, at a time where investors don't really want to tip into capital raises, cash flow is king. So very important sort of pivotal point for capital's history here.
Yeah, that is the key. So we've seen how companies, when they get, when the market gets concerned about their cash balance, how they're going to fund future development, they get sold off. This is a company that's about to tick over into cash flow positive, and that's why we're backing it here. And we really like it around this dollar mark. Shawn, you were going to add something there before I cut you off, or Harry cut you off. You're just on mute there, Shawn.
Okay, let's try again. Between Harry and I, we're not killing it on the audio front today.
We're only a few years into a pandemic and been using Zoom.
Exactly.
Yeah.
So I was just going to add at the beginning of the small stock side of things, there's a huge correlation between interest rates and the smaller ordinaries. People, small companies are competing to raise money. If interest rates are higher, it costs them more to get funding. It also takes liquidity out of the system. One of the first places where that liquidity can often come from is the small ordinaries. So what I'm trying to say is, if we are correct at Market Matters and interest rates and bond yields are close to a pivot top, this is a great time, as Harry alluded to start accumulating the small caps. Might not be today, but they are look very well positioned.
Yeah, put simply, so you think about US Treasuries, you put a margin on that might be a 600 basis point margin for some of these companies borrowing in the high yield US bond market. You're getting an interest rate of about 11%. That's a really high cost of capital. So these companies coming into cash flow break even and actually producing dollars is really important. Praemium, Harry, this is a platform company. We use Praemium every day. It's a $305 million market cap company. It's on 19 times earnings. The comparable stocks on the ASX that are larger and have done better are Hub and Netwealth. Hub's got a market cap of 2.7 billion and Netwealth's got a market cap of 3.7 billion. Both of those, last look, I haven't looked in the last couple of days, but last look, they're on about 40 times FY24 earnings. Praemium is on 19 times, huge discount. We've been patient here. Should we continue to be patient?
Yeah, a bit of reminiscing about our position in Ramsey there. They had a bid that sort of fell through, and there was reasons for that. It's sort of not, can't really blame the board for how that one played out, but kicking ourselves for not taking the profit that was there. It's a far cleaner business now. They've had some issues to work through in terms of selling their international side of things. But purely, like you said, on a valuation perspective, they're trading at a 30% discount on their historical sort of levels and a 50% discount to peers. Business is doing pretty well. They are still seeing some fluid inflows. They will need to grow that pretty substantially. But once again, cash flow positive after selling the international side. Really good base to grow here. And I don't think we're going to see the end of this shift to these sort of independent platform players that Praemium, Hub and Netwealth sort of are dominating in our space at the moment. So Praemium being the cheapest and the one we like for this portfolio.
Yeah, we've held Hub in the past. We took profits on it. Obviously, had a great FY23 results and stormed higher as a consequence of that. But we like these sorts of businesses where there's so much operational leverage within them. So once they've built the platform, although there is ongoing costs to continually improve that platform, the incremental dollar that comes in really turns this turns a dial on earnings. So we like these businesses. There's a business at the back end of this presentation that we're going to run through that shows you the power of platform businesses, the power of asset management businesses, and effectively that's what Praemium and Hub and Net Wealth they are. They accumulate assets on their platforms. They earn a fee on those assets, and they can easily add incremental assets to their platform without increasing the cost side of it. So Praemium is a cheaper, less known, smaller cap way of getting exposure to that thematic that we continue to like. Consumer staples, the next sector that is unloved, has been unloved, but it's sort of been a tale of two halves, Shawn. They're down 1.1% for the year, so it hasn't been a diabolical period for the consumer staples. They're the worst performing sector, I should add. But as I said, it's the tale of two halves. So pre-reporting, so pre-FY23 results, consumer staples were bid up. There was this view in the market that this was the place to be, the safety area of the market, that these guys that sold products that we all need to buy were going to do particularly well. And those discretionary retailers, those nice to have sellers of things would do worse. That hasn't played out. So, pre-reporting they were strong. Post-reporting they've been weak. There's been a lot of cost pressures come into this sector generally. What do you make of it from a sector point of view?
Well, I think you just summed it up at the beginning of that, James. Is the market went a bit all in one way. They went against discretionary spending, a bit like everyone's been against real estate over the last year, and they thought that people are still going to eat, they're still going to go to Woolworths, etc. So that's the place to have your money. But if everyone's pointing the same way, who's left to buy? And then we had this. I wouldn't say necessarily the big surprise, but it was a surprise when we compare it to valuation. As you say, cost pressures were higher, wages costs were blown up, and this sector was simply too expensive. Something we've written about a few times. People were being very defensive this year. This has been often called the bull market that no one loves. And one of the places where they were hiding was in the consumer staples, the likes of Woolworths and Coles, etc. So they were hiding in areas they thought were safe. They were overweight. Those areas were safe. And those are areas, and that by definition, pushing the prices up, pushing the valuations up. And we've seen them come off because they weren't warranted. They were too expensive when we saw the price of wages going up, etc., etc. So if you look at stocks like Woolworths, they've had a big pullback. And even today, Woolworths is... So you've got Coles coming up. It's had an even bigger pullback. But Woolworths has had over 10% pullback of late. It's the stronger of the major two. We believe it should be, but even right now, it's still trading above its long-term 5-year average. We've still got people wanting to own these stocks, feeling comfortable, feeling safe in them, but it's still 5% above its long-term average. So we think it deserves to be more expensive than Coles, which we'll go back to. But I believe. And for the first time, actually, in a while, I think that because I believe that the cost pressures from wages are starting to dissipate or improve, Woolworths might actually be able to get a bit of a kick up. But they simply got too expensive.
Yeah, there's two really. We're framing this webinar as the unloved part of the market. So consumer staples is an unloved sector in the market. But there's been a lot of divergence between the individual constituents of that sector. So Coles, you can see on the chart there, it is an unloved stock in this area. So it's sub $16. They were sort of $18 prior to results. They've been hit as a consequence of that. Coles is not the business that Woolies is, and the reason for that is a lack of investment over a prolonged period of time. You can blame Wesfarmers for that. So Wesfarmers had Coles in their stable. They didn't invest properly in the business. They were investing more heavily in the Bunnings business. As a consequence of that, and this is what we saw through FY23 results, they had less control over their margins. So they had less control over getting out efficiencies in their supply chains, getting efficiencies in how they were, their promotional activities. You look at one obvious example was the self-checkout at Coles versus Woolies. There's a heap of theft coming through Coles, and they called this out in their results, yet there's no real theft coming through in Woolworths. The technology that Woolworths employs is far superior than it is in Coles. So whilst we're framing it as unloved, parts of the market, We don't think Coles is probably the place to be in this area. It's cheaper than it has been, but I don't think it's cheap enough. They've got a huge amount of capex they need to spend to get aligned with Woolies, and we know how what drives these type of stocks is scale and efficiencies, and Coles simply doesn't have that. So we don't think buying Coles into these, the bottom end of the trading range is worthwhile. We think Woolies at around $37 is reasonable value, okay value. It's a really high quality business. If we were buying one of the majors out of those two, we'd still buy Woolies here rather than going deep into the value space of Coles, because we simply think they've got too big a road to move from. And then finally, Metcash, and this is one we own in our active income portfolio. We do own it from lower levels. We've held it for quite a while. We like this stock. It's got it's got a hardware business. It's a slightly different beast to Woolies and Coles, but we like it more in terms of their convenience offering. The hardware side of the business is growing in the proportion of their overall business. So when a hardware business grows at a quicker rate than the grocery side, that will over time become a greater proportion of their earnings, and therefore the multiple that the market pays for Metcash will increase. So we're seeing earnings growth and a multiple re-rate moving forward in terms of Metcash as a reason to buy that one. It's cheap, it's got a great yield, and we like that. Have you anything more to add on that, Shawn?
Not really. I think that out of the Coles and Woolworths, I see no reason to really pucker up and buy either here, especially not Coles, as you said. They might be trading slightly cheap, but we've seen it so many times over the last year or two. When people have to do tech upgrades, it always blows out. It never comes in. It never comes in cheaper than expected.
Certainly doesn't Market Matters, let me tell you.
Exactly. Still looking the wounds there. So when you look at Metcash, I think of the three, it stands head and shoulders above where we would even still consider it for the flagship growth portfolio.
Yeah, it's a stretch to call it a growth stock, because I don't think it is one of those. I think that the industry is not growing collectively a strong enough clip to warrant that. But it is. You can see them. When we've seen it in Telstra and we've seen it in other stocks, and Shawn and I have often had this argument about what should go in, what's applicable to what portfolio. Shawn's all about things that go up that should go in any portfolio rather than the earnings profile that they've got. And I sort of agree with that, but you've got to split out the portfolios into themes, and income, etc., is really important for the income portfolio, more stability in earnings. So it gives you a sense of the arguments that take place on the investment committee at Market Matters, and thrashing out ideas. And I think that's really important. Challenging each other's viewpoint is really important, and having a broader investment team here at Market Matters certainly does that. And hopefully over time we've delivered in our portfolios, so that sort of that process, that testing of ideas certainly works out. I'm going to move on to a quick promo just in there in terms of the portfolios that we've got available for investment. The portfolios that we've got here are open for investment. So the active high conviction portfolio, it's actually the active growth portfolio. We're renaming that very shortly. The income portfolio and the emerging companies portfolio, they're all open for investment, and you can put funds very easily through the Market Matters website into those portfolio's.
Sorry, James, just very quickly as well. This side of Christmas, we should have the international portfolio up and running as well.
Yeah, that's been we've been working hard to get this one off the line for quite a while. It's a little bit more challenging from the international standpoint to deliver a portfolio economically. So we're trying to land this sub 1%, all in, zero brokerage, like we've done the other portfolios. So we want to really deliver a compelling offering into the marketplace, and it's taken a little bit more time to do that. But this side of Christmas is we're still on track to be able to launch that. High conviction calls. We like a high conviction call. Invariably, when you put a couple of stocks up there as high conviction calls, they don't deliver for you, but we'll have a go anyway. Shawn, you've brought Treasury Wines across, which is a member of our flagship growth portfolio. Looks good around that $12 mark if it can break out. What are your thoughts?
No, absolutely. If you'd asked me 2 or 3 weeks ago, I might have said Paladin, but it's probably getting closer to a sell than a buy now. I notice it's up again, knocking on its mega multi-year highs today.
Harry and I were just talking about that before coming up and doing this webinar around, Paladin. It's been nothing happens for quite a while, and then suddenly it rips higher. So 110 or so, Harry, it was when I left the desk. Not sure what it was when but it's been phenomenal
Yeah,
performer.
about what? Yeah, 110, 111. It actually opened lower as well. So a really good fight back in the day that sellers tried to take hold after a really strong run. So still buying support out there across the uranium names at the moment.
Yeah, Paladin's in our flagship growth portfolio and our emerging companies portfolio, and we've got Cameco in our international equities portfolio. Anyway, we digress, Shawn. Apologies. Treasury
No,
wines.
I think Treasury Wines is really, really good value around $12. It's trading around fair value. It's not overly cheap right here. But what I love about the business model, they had to reinvent themselves. And we all can see what happened back in 2019, 2020, when we saw that the Scott Morrison made a few adverse comments towards China, and bang, they cut off our wine imports. Very, very painful for Treasury Wines and a few other players. They've reinvented themselves as a company. A lot of wines now going into the States, etc. But I don't believe there's 0% of that price around $12, or there might be a few percent, but it's almost an irrelevant amount, which is factoring in the possibility that wine might follow the likes of barley and the doors might slowly reopen into China. If that does, I can see the stock up 20, 30% in a matter of months. I think the downside is very, very limited, but the upside, I think, is being undercalled by the market.
Yeah, we haven't modeled any benefit of China reopening into our thesis on Treasury wine. So it all comes down to we own this stock because of what they call their premiumization strategy, which basically means that they're selling higher quality wines into markets that are prepared to pay more for them. Under this strategy, we forecast earnings over the next 3 years to grow at 10%. Which is a compound annual growth rate of 10% at the EPS line is strong, and we think that should be just on that basis, Treasury should be sort of $14, and then you throw in that wild card that it's very hard to predict China and what they'll do, and but we see upside in that. We don't see any more. There's by definition no more downside from the China relationship, and TWE will take it or leave it if it suits them. Which I think is a great position to be in. So what played out a couple of years ago was hurtful for those who owned it at that point in time. We didn't. We've now looking at this stock, and we see really good earnings growth over the next 3 years. But it's also not. It's not a high beta stock from a market's point of view, so it tends to run its own race. So you'll often see Treasury wine estates up on days where the market is down. So we like it from that respect. It helps the beta of our portfolio, or contain the beta of our portfolio.
A lot of people call it defensive. Simple as that.
Yeah, exactly right. SRG Global. Harry, Construction Services, it's a $325 million market cap company, so it's small. It's come back from 80 odd cents down to 65 cents. It's been hit reasonably hard in the last little while. We owned it. We bought it, I think, correct me if I'm wrong, but in the low 60s. We didn't sell it at 80s. We're back to levels where we acquired it at, or just above where we acquired it at. Take us through the quick thesis why we still like this stock.
Yeah, we added to SRG as well down low, but we are down a little bit on the stock at the moment. Do have to throw in a small dividend there, but they've sort of got three sides to the business: asset care, mining, and engineering construction. Their FY23 result, they reported really well, and they actually came into the office, and we managed to have a chat to them about their report. Market didn't like it purely from a cash generation perspective. And in our view, that they're sort of missing the point. SRG won $1.1 billion of work last year. They've got a $6.5 billion pipeline to bid for work at the moment. And that's a huge opportunity for SRG. You said their market cap's below 400 million at the moment. When you've got a pipeline like that, it doesn't quite compute on our numbers. It's cheap versus peers. It's doing really well. They've guided to 20% EBITDA growth in FY24. And I think it's too cheap to be trading where it is heading into FY24 on the back of that. And those cash flow, well, it's not a cash flow issue. It's just sort of, the margins, the cash margins they were getting on those contracts were a little bit light, but that's more because they had to invest to grow. So they continue to grow. I think that EBITDA guidance will be proved conservative by the end of it. And we just want to see some continued contract wins picking up over the next few months to really drive that valuation. But really solid business, really solid earnings profile, and cheap in our view at the moment, James.
I think the market. So the market's probably rightly concerned about delivering work profitably. So this is the same thing that is often played out from. I liken it to Worley Parsons, in the bigger area of the market. So and a Lend-Lease to a lesser degree. So they never had a problem winning work, but they had a problem delivering work profitably. So those really, razor thin margins in these contracting businesses have meant that they've ultimately been poor investments. That is changing as this big push into global decarbonisation happens. There's a lot more money going into this area of the market. But what it's also doing is these contractors are getting more rational in the way they price work. They're putting more risk back onto the client that's employing them to deliver the work. So the whole sector hasn't worked particularly well over a long period of time, but that is changing. It's changing more in the decarbonisation side. And Worley, I should say, it's not Worley Parsons, it's Worley, are going to be huge beneficiaries of that in the next 5, 10, 20 years. But so are these flow-on sort of associated service providers like SRG Global, if they price their work well. And SRG has a history of doing that. You can only go back on history, and SRG has a good history of doing that.
Exactly. I think you can. After you, Harry.
In terms of contract and margins themselves weren't really the issue. It was the money that they had to invest upfront to win these contracts. So these positions they're taking and the contracts they're winning, they're going to have to put a little bit of money ahead of the curve before they see that revenue come through. And that was sort of a slight issue for the market. It wasn't so much that the margins on the contracts themselves were an issue. So I think once investors start to get a handle on that, they'll start to price SRG correctly in our view, and correctly for us is high from where it's trading at the moment.
And I was just going to add, I think the fairly recent collapse of RCR is going to help a lot of these businesses, even if they're not directly in that space. It just goes to show that when people are tending for this work, as you pointed out before, they want a decent margin. Otherwise, they'd rather walk away.
Yep. Gee, that's a blast from the past, Shawn. RCR that collapsed a little while ago.
I didn't know any, fortunately.
Okay, now I'm gonna the second last high conviction call I've got for you is Blackstone. This is in our international equities portfolio, BXUS. It's actually writing the report this morning, portfolio positioning report for Market Matters. This was down 7% in the past week, but I just want to touch on a couple of key highlights. So they're an asset management company, the world's biggest alternative asset management company, I should say. They manage $1 trillion in assets. That's a huge number, $1 trillion. Write that down. They're the biggest alternative asset manager, I said, in the world. To give you an idea, they trade on about 18 times earnings on FY24. They're going to make about $7.4 billion in FY24, but they have 3,000 employees. Or about 3,000 employees. So if you back solve that and you think about a business, if you're in business or you run a business or you think about business, $7.4 billion in profit on 3,000 employees is about $2.5 million worth of profit, after tax profit per employee. That's a phenomenal business, and why asset managers are such great investments if they get it right. So you can grow, as we said earlier, around when we're talking about premium, you can grow that incremental earnings dollar very easily. You don't have to take a lot of headcount to add that to add that earnings onto the bottom line. So we really like this stock. We've got it in our international equities portfolio. We have bought it from lower levels, but we'd be happy to buy it from around this 110 mark. It's not, it is an unloved sector to a degree. It's obviously been high of 150 and it's based out sort of sub 80 and it's now at 110. We still think this area is unloved. There's a lot of concern around US property. They're a big property investor. There's a lot of concern playing out in terms of US property markets still. But we think Blackstone, if there's one company out there that can take advantage of dislocation in markets, opportunities in markets, Blackstone is certainly the stock that can do that, or company that can do that. Guys, anything else to add on that one?
Oh, no, I just think as a long-term investor, a pullback in the market for a company that's got cash is exactly what they want. It fits exactly with their long-term view. People trying to trade these stocks month to month may be a bit scary, but in the bigger picture, I think it looks great as well.
Harry's mute there, so we'll just take that nod as a nod of approval, Harry. Looking now at Magellan, which is a hugely divisive stock. We've bought this recently in 2 of our portfolios. We copped more emails on Magellan than we have on most of other stocks that we've gone out there and buy. There's a lot of people saying, why would you go out there and buy that? I'll give you my quick thesis in 10 seconds around Magellan. They've got $40 billion worth of FUM. They've got about half of the share price in principal investments and about half ascribed to the funds business. That puts the funds business on about a P of about 7, which is cheap. We know that performance has been atrocious, and we know all the documented reasons why the share price has fallen from 75 down to sub 10. But those things are improving. It stems from performance. If they improve performance, which they have started to do, outflows will stop, which they've started to do, and inflows will ensue. So we think they've got a really credible path to redemption, and that's why we've added Magellan to 2 portfolios. We haven't taken huge positions in it, but we think there's a real credible path to redemption for Magellan, Shawn.
No, absolutely, and I echo everything you said. I think that it's only got to go back to $12, $13, and we've got 25% up our sleeve. The stock is very, very cheap. It's still being priced for further outflows. I can't imagine if I was going to pull money out of Magellan, I'd be doing it now that they're starting to improve performance. Surely one would have done it over the last year or 2. So I think those outflows will slow right down or stop. Well, if we actually started to see some decent inflows, the stock would be popping back above that $11 mark. And don't forget, we've also picked up a very healthy dividend along the way. I think the stock looks fantastic around here.
It's interesting. They have had huge outflows. There's no doubt about that. They managed over $1 billion in FUM, and they're now down to $40 billion in FUM. And that's obviously hurt the business, the earnings side of the business. I spoke about asset managers being highly leveraged operationally. That's also true when funds walk out the door. One of the things in their FY23 results, why the stock rallied 13% on the day, was around reduced cost guidance for FY24 and beyond. So just in terms of their performance, they've done 16.77% over the past 6 months, which is only about 1% above the benchmark. Over 3 years, they've done 5.3% per annum, and that compares to the Market Matters international equities portfolio that's done nearly 15%. So 3 times what Magellan has delivered. But from an investment standpoint in Magellan, we think the worm is turning here. So I know we look at this one quite regularly on the desk, Harry.
Yeah, we do. We look at across the space as well. So it's not just Magellan that's been hammered. Obviously, Magellan's been the worst performer across a lot of the names in the space. But like you said, if performance starts to turn and fund flow starts to turn, it doesn't really have to do much to justify the numbers it's on at the moment, and a really strong capital backing to support that valuation here.
Yeah, we think so. Talking about unloved sectors or areas of the market, we think the funds management space, the active funds management space, I know they've copped a really hard time, and the rise of ETFs have really put a cloud over the active funds management space. But if you can actually add alpha, add value, and then you will attract money. and we think this is a market, and we're talking our own book here because we are active managers, but we think this is a market, given the macroeconomic dynamics, where you can add. It's easier to add alpha. It's easier to add value. That's certainly been the case across our portfolios in recent times, and we think that's going to be the same across. We're not on an island. We think others can also add alpha in these sorts of markets if they approach it in the right way, and we think there's tangible signs that the team at Magellan are doing that.
Exactly. I think we should just add there, I think we've seen generational lows in bond yields and interest rates. I don't think any of us will see 0% interest rates again. I hope not. Otherwise, it will probably mean something really horrendous has happened. And if that's the case, we've seen a change in trend there. And I believe that will flow through to active managers. Simple as that, because we are seeing huge rotation between stocks and the sectors. And that has got years and years to play out, in my opinion.
Yeah. Peak ETF flows, peak passive ETF flows. Would be a thought there. I'm just going to finish with one. It's a bit boring, but it's APA Group. APA is the ticker for that. It's trading sub $8.50 at the moment. It is high conviction from an income point of view. It's very unloved at the moment. APA is this. It is a regulated utility stock, has energy pipelines. It's involved in renewables infrastructure and a bunch of other things. They just raised a truckload of money, about nearly 700 million, to buy some assets in the Pilbara, some energy assets in the Pilbara. The stock's been sold down as a consequence of that. There are a few other moving parts here, but we think the sell down for this equity raise is presenting an opportunity. Historically, buying this stock anywhere near a 6% yield has delivered strong returns. We're now looking at a 6.8% dividend yield moving forward. It's not that exciting. It's not going to make you wealthy, but it's an income stock that we're high conviction on. We're slightly down in our income portfolio on this position. We bought it towards the bottom end of the range, but we haven't bought it right at the low of the range. We think it's near the low of the range, or it's hit the low of the range as it trades at the moment. I'm going to finish up on today's webinar. I know there's a couple of questions, and I'll get to those. I'll cast my eye over those very shortly. Just a quick plug of Market Matters Invest. It's a digital investment platform where our subscribers and others that like the Market Matters approach and want to back the Market Matters approach can invest really easily across a suite of portfolios. At the moment, we've got our growth portfolio, our income portfolio, and our emerging companies portfolio available for investment. It's really easy to sign up. You can go and open an account in about 5 minutes. It's all digital online. You can see the performance of your portfolio. You can generate all sorts of reports on the portfolio. You can look at the app. All annual reports are audited and all packaged up in a nice bow for you. So we think it's a really great offering. We charge it at 85 basis points per annum, inclusive of GST, and that includes all brokerage, so zero brokerage across these portfolios. So that is what we think is a really good offering out there for subscribers and others involved or interested in Market Matters. Performance has been strong. You get a monthly performance report and the like. So go and check it out. It's available on the Market Matters website.